All right, welcome to The Explainer. Today, we're diving deep into a stock analysis of the coffee roaster and distributor Farmer Bros. Co. You'll find them under the ticker FARM. On the surface, Farmer Bros. Looks like a pretty simple, stable business, right? I mean, they roast and distribute coffee to restaurants and stores. And let's be real, who doesn't love coffee? Consumption is super resilient, so you'd think this would be a pretty safe bet. But here's the thing. The stock is trading at a really low price. And that always makes you wonder, right? Is this a hidden gem, a deeply undervalued stock just waiting to pop? Or is it a classic value trap? Okay, let's dig in and find out what the numbers are really telling us. All right, so first things first, let's really get a handle on the business itself and see where some of the first red flags start to show up. Because, just because a business is simple doesn't mean it's strong. And this really gets to the heart of the conflict here. You've got this promise, right? The idea that coffee consumption is resilient, that there's this recurring revenue stream. But then you have the problem, the harsh reality that this is a commodity business. We're talking thin margins, very little to set them apart from the next guy, and just intense competition. There's really nothing stopping a restaurant from just switching to a cheaper supplier tomorrow. And this just hammers home the core issues. Farmer Bros. Just doesn't have the scale that its bigger competitors do. There's no durable competitive advantage, no moat, as they say, to protect its business. For their customers, the switching costs are basically zero. And in a B2B market like this, brand loyalty? Pretty weak. On top of all that, you've got declining revenue and some serious structural inefficiencies. That's not a strong foundation for any business, that's for sure.
Okay, so that's the story of the business. But what about the numbers? How does this all look on a spreadsheet? Let's get into the financial evidence, because this is really where the rubber meets the road.
And right out of the gate, profitability is a huge red flag. A negative net profit margin of over 5%, what that means is for every single dollar of coffee they sell, they're actually losing more than 5 cents. Think about that. Their core business is fundamentally unprofitable. And honestly, it gets worse from there. Just look at the return on equity. This number tells you how well a company is using shareholder money to generate profits. And a figure of negative 48%, that's alarming. It means the company isn't just failing to create value for its shareholders, it's actively destroying it, and at a really significant rate. So, turning to the balance sheet, with profitability this bad, you're really hoping they don't have a mountain of debt. But, well, they do. A debt-to-equity ratio of over 150%, that shows they are very, very highly leveraged. And for a company that's already losing money, that is an incredibly dangerous place to be.
Now, there is one potential bright spot, to be fair. The company is generating some positive free cash flow. But, and this is a really big but, it's a pretty modest amount. It's just nowhere near enough to offset the massive risks we've just talked about, the awful profitability and that huge pile of debt.
Okay, so with that really troubling financial picture in mind, the big question is, what's this company actually worth? What does the analysis say? So the analysis here uses a couple of different methods to try and figure out the company's true or intrinsic value. And the results put it somewhere in the range of $1.10 to $1.35 per share. Now, considering the stock is already trading right in that zone, it tells you there's basically no margin of safety. The price offers zero cushion if things go south. And this weighted SWOT analysis, it paints a really clear picture. Just look at how the biggest weight is given to the weaknesses, things like the debt and those terrible margins. They're so significant that they pretty much cancel out the only real strength, which is that stable coffee demand. The final score here is just mediocre. It really reflects a business that is fundamentally challenged from the inside out.
And when you start looking at the different potential futures, it really drives the point home. The base case, where things just kind of stabilize and don't get worse, values the stock at about $1.10. To believe in the bull case, the optimistic scenario of $1.80, you have to bet on a complete successful turnaround. And based on what we've seen, that feels pretty speculative. Meanwhile, the bear case, the downside, the stock could drop to just 70 cents. The risk here just seems to be way bigger than the potential reward.
So, with all that said, let's say you're still interested. What price would you need to pay to even have a reasonable shot at making a decent return here? Now, this is really fascinating. To hit a target of a 9% annual return over a 16-year period, the analysis shows you'd have to buy this stock at or below 90 cents. That's a huge discount from where it's trading now, and it's a perfect illustration of that whole margin of safety concept we were just talking about. And this just doubles down on that same point. It shows that your time horizon really matters too. For a shorter, say, 5-year hold, the buy price is a bit higher. But for any investor looking to hold for 10 years or more, that sub $1 price becomes absolutely critical if you want to have any hope of a decent return. All right, let's pull all this evidence together. What's the final verdict from this analysis? Bargain or trap? Well, the scores here really tell the story in a nutshell. You've got a high-risk score, a 7.2 out of 10, and that's up against a very limited opportunity score of just 4.8. I mean, based on those numbers alone, the risk just does not seem to justify the potential reward. And this quote from the analysis really nails it. Farmer Bros is a classic deep value candidate that risks becoming a value trap. It's one of those stocks that looks cheap on the surface, but the underlying problems are just so severe that it's way more likely to trap your money than to actually reward you. So the big takeaway from all this is simple. The analysis shows the stock completely lacks a sufficient margin of safety at its current price. There's just no buffer. If anything else goes wrong, and let's face it, with this business the risks are high, there is zero cushion to protect your investment. And that leads us to the final verdict from the source analysis, which is pretty decisive. Avoid. It's only something you might consider as a super high-risk speculative turnaround play, and only if you can get it at a very, very steep discount. We're talking below that 90-cent mark.
So there you have it. The deep dive concludes that Farmer Bros is pretty much a textbook value trap. But now we'd love to hear from you. What stock should we analyze next? Drop your suggestions in the comments below.